Hey guys, what's up? I'm Erin and welcome back to the channel. If you pay attention to the stock market, and chances are if you're the type who's sitting around watching finance videos here on YouTube, you are the type who pays attention to the stock market, you probably saw what happened with the stock market on Monday, August 5th, 2024. News headlines were all reporting a global sell-off and a tanking of the stock market. Likewise, pretty much every financial YouTuber out there was putting out a video that said something to the effect like, the next recession is here, or the recession just started, or the stock market is crashing, and what you can do to protect yourself. Across the board, losses were reported, with the Dow Jones falling more than 1,000 points, the Nasdaq falling more than 500 points, and the S&P dropping about 160 points. These are not insignificant single-day drops. Between Friday, August 2nd and Monday, August 5th, the stock market was hit hard. In fact, at one point, the S&P had over a 5% drop over just this two-day period. The Nasdaq had nearly an 8% drop, again, over just a two-day period. Now, because at my core, I am a long-term investor, I don't want to promote the idea of trying to time the market, or I don't want to get overly reactive to a certain set of events or a specific set of days. Zooming out year to date, the S&P 500 is still up nearly 13%, which is a phenomenal performance. As the saying goes, time in the market beats timing the market. You never know when those bad days are going to be, just like you never know when those good days are going to be. And missing out on those good days will prove to be a costly mistake for investors. If you miss out on the 10 best days in the market, your returns will be cut in half. And if you are somehow unlucky enough to miss out on the 30 best days in the market of a given year, your returns would be cut by roughly 83%. So the moral of the story is to just stay invested. Over the course of a 40-year investing career, it's very likely that you would see anywhere from 5 to 7 very significant market downturns. But if we start talking about individual investing days like this, you're likely to have hundreds of them throughout your investing career. I actually have a video that goes over if you had impeccable market timing and comparing that to if you had absolutely terrible market timing, looking at if you were to invest at the very top of every bubble and also comparing that to if you were to invest at the bottom of every single trough before the recovery started. I'll link that video here if you're interested in checking it out. So the question is why? Why was every headline screaming about what was happening in the market? Well, it's because market volatility makes headlines. It's because it gets people to click. Headlines like this make people click. The first question we could ask is why? Why was there a global sell-off? Why was the market hit so hard on Monday, August 5th, only to turn around and then start back up on an upward trend again? Well, to answer this question, we have to rewind a little bit. Back in 2022, inflation started on a pretty hefty upward trend, peaking at just over 9%. Inflation at such high levels isn't great for the economy. It reduces the value of the dollar and diminishes our purchasing power. So the Fed stepped in and started to increase interest rates. And this was a deliberate move to slow economic activity, to bring inflation back down. But really, it's a delicate dance. The Fed doesn't want to increase interest rates so much that it kicks us into a recession. Rather, they just want to slow down or cool down the economy. The good news is that today, inflation is in a much better place. These days, it hovers around 3%. But as inflation starts to get under control, naturally the talks start to emerge as to when the Fed will need to start to cut interest rates. Because if interest rates stay too high for too long, that can kick the economy into a recession. And again, a recession isn't great for an economy. Well, on August 1st, the Thursday before the start of the big two-day sell-off, economic data was released, which showed that the manufacturing segment of our economy was still in a decline, and importantly for the context of this conversation, weaker than expected data was released in the labor market, specifically concerning the number of jobless claims reported. This triggered a reaction from investors that perhaps a recession is looming. It also triggered questions that, did perhaps the Fed make a mistake by not beginning interest rate cuts last month in July? Or does this mean that they're now going to have to make deeper rate cuts going forward? Basically, it triggered a bit of panic. Now, were these numbers in and of themselves alarming? No, but when it comes to the stock market, expectations are everything. If data comes in that exceeds expectations, the stock market heads on an upward trend. If data comes in that misses the mark of expectations, the stock market heads down. The market reacts and it overreacts. For instance, let's say we have a company that's a major player on the stock market. We'll call this Company X. And let's say the expectation is that Company X is going to report earnings growth of 10% this quarter. If they release a report saying earnings grew at a rate of 11%, that stock is going to be heading for new heights. But if that earnings report comes out and growth was only 9%, that stock is going to be hit hard. Take a moment and think about that objectively. The company still grew. That should be a net positive for investors. But because the company didn't grow by as much as the set expectation, the stock price takes a hit. Now, going back to what recently happened, just as quickly as that sell-off happened, the market began to rebound. The overreaction by some was seen as a buying opportunity by others, and that turned the market into an upward direction. So these wild mood swings by investors and speculators are kind of what makes it easier for long-term investors to just stay invested, stay the course, and just ignore all the noise. I think the other interesting question, other than why do fluctuations like this happen, is where does this money go? You see headlines like the Magnificent Seven lost nearly a combined $1 trillion in the heart of the trading day on Monday. I think it's kind of natural to say, where'd the money go? But the answer is it didn't really go anywhere. It was just sort of erased. The money physically didn't go anywhere. What happened is that there was a change in perceived value. There was a change in the perceived value of these investments and these companies. Now, in this instance, or instances like this where there's broad market sell-offs, there isn't anything any one individual company did to have their perceived value decrease. It's not like one of these companies did something to have their stock price individually plummet by 5% or so. It was really a more broad reaction to broad economic data. So basically, investors were saying, as a whole, I'm perceiving our economy as less valuable. And in turn, the stock market as a whole is going to take a hit for that. I think it's very reasonable to say that even though the news outlets were reporting that collectively the Magnificent Seven lost $1 trillion in value on that trading day, there was nothing that these individual companies did to reduce their value in the investors' eyes by that amount. It wasn't, for instance, mismanagement by a company executive, poor products, or weak sales. It wasn't actually bad news coming out by one or all of these companies. So a reasonable and prudent investor would recognize that staying invested in solid companies with strong economic futures would be the best course of action, regardless of what the headlines read today. Also, this type of loss is often referred to as a paper loss because it's an unrealized loss. Basically, your account balance is now reading lower, but you didn't really lose money. You only lose money if you execute the sale of your shares of stock or the shares of your index fund and you lock in that loss. I think when volatility takes hold of the market like this, I find it helpful to remind myself that I'm actually investing in individual companies. It's not just numbers on a chart that go up and down. When I put my money into an index fund, there are companies that make up that index fund. I'm betting on the US economy as a whole growing and going forward. I'm betting on that upward trajectory. One job report, one meeting by the Fed, one change to the interest rates, or one election does not change that. The market reacts and the market overreacts. This is something that has always been true of the stock market. I think what's most important is that you focus on the long term. Don't get lost in the minutiae. When you are a long-term investor, just sit back and enjoy the ride. And how conservatively or aggressively you should be investing, basically how much swing you should be dealing with in your portfolio, really comes down to what I call the pillow test. You should invest in a way that allows you to sleep soundly at night. Those headlines, they're just headlines. Keep doing what you're doing, keep dollar cost averaging, stay invested, keep your money in the market, and in the long term, you'll be just fine. What do you think about what happened on Monday, August 5th? Did it cause your stomach to do a little flip, or were you just fine? Share your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.